Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to go to focuscompounding.com to get access to all of our investment write-ups going all the way back to 2005 for free. Wherever you are listening or watching us here today, hit the subscribe button so you will be notified every time we upload a new podcast. 6 years running, Geoff.
Is that how long we've been doing the podcast?
Did not even give it a shout out at the end of February that we had crossed the 6-year mark. But yeah, 6 years of doing the podcast. So pretty crazy. And you can get access to all of that backlog, all for free at wherever you're listening or watching us currently right now, either through YouTube, podcast app, Focus Compounding, wherever. It's out there on the internet. So in today's podcast, Geoff, we're going to go over one of the most common questions we get. And that's this idea of growth and what it means and what it means to you. I want to talk about what you think it means to somebody like Buffett. What do you think it meant to somebody like Munger? And what does it mean to you in your own investing, right? There are a lot of different ways that people invest. It seems like, there are a lot of different ways you can quantify growth. What does that mean? Is that a top line number? Is that an EPS number? Is it growing revenues slower than earnings per share? Is it cash flow growing faster than revenue? What does that mean? Or free cash flow? Let's talk about it. What does growth mean to you? And do you look at every single company's version of growth the same? Or is each situation a little bit different, right? We've talked about before that a slow growing company could be a gold mine, right? If they're doing smart things with capital allocation, whereas a fast growing company, could be the opposite of that. So let's talk about growth, what it means to you. Maybe you could talk about, I'm sure you get asked that often, and then we'll just kind of go from there. So what does growth mean to you, and what is good growth that you like to see, and what is bad growth?
Well, you get asked questions about growth all the time because I think it's something people put in a formula to figure out what a stock should be worth or something. I don't think that growth tends to be very important in the value of a stock. Ben Graham came up with a formula, not one he used or anything, but one that he showed in some of the things that he wrote, trying to explain why a P of something would be higher and how that should be related to the growth rate. The problem is that what matters is your return in the stock, and that's going to be driven by your growth in something like earnings per share related to the multiple, but also how much capital the company returns to you or that it has to add to the business over time. So what really matters when you're looking at it is doing a point-to-point calculation of how much higher earnings will be in the future, and then basically taxing it by how much capital it's going to have to add to it. So a good example of a company that I think is way overvalued is Costco. And the reason for that is because it cannot return much earnings to people, and it can't grow very fast because it's a very tangible business, So here you have something that is not a growth company. And if Costco and FICO are priced in similar ways, I might think FICO is way overpriced too, but there's much more of a case to be made for FICO than for Costco because Costco has much lower returns on capital and all of that. Basically what it means is that Costco has to invest a lot of money to grow. And yes, to a point, it can grow earnings per share faster than it can grow revenue, but that's the problem that you face there. And I think that that's the most important part. A lot of things we talk about are companies that don't have profits or how fast could they grow or whatever. Some of this is just meaningless because, how fast could an insurance company grow if it doesn't have to show a profit? It can grow as fast as it wants. How fast do all sorts of things can they grow? Their growth rate is limited by how willing they are to worry about other things like profits now and how much capital they're putting out. So I don't think that it's total addressable market makes more sense as something to look at if you had to look for growth potential and stuff than actually how fast the company is growing, because how fast the company is growing depends on the quality of the profitability of what it's demanding. If it's just trying to show revenue growth, then obviously you can do that without worrying about anything else. And the worst cases you have your Enrons and things like that, and maybe some things in the deals between companies and AI right now where they can show growth, but it's probably on things that aren't profitable or aren't really revenue. They're just booking deals between each other. And it shows up as growth because they know that people value revenue growth over time. And we'll use that number.
So when you think about growth, is it really for you, it's all how that translates into earnings per share?
Yeah, it only matters on a per share basis. It only matters in some terms of earnings or assets. It doesn't matter in terms of anything else.
Why do you think Costco is trading at 50 times EV to free cash flow? People buying it here at these levels. How do you justify that? So like it's like a 2% dividend yield, right? The narrative has sort of, or not dividend yield, EV to free cash flow yield. And, the narrative before was interest rates are nothing, so you can justify paying up a little bit. Here we are at 50 times. Is it more so what they could do internationally? I mean, I remember Starbucks for the longest time. That's sort of what the pitch was. How would you think about that?
No, it doesn't. I mean, you can look at the returns on equity, the returns on invested capital, how much they have to invest. You can see their revenue growth, what it is versus how much capital they have to do. It doesn't make sense to me because there's no way that you could grow earnings a lot without having to increase the amount of capital that you have a lot in it. If you increase the amount of capital, then how are your earnings going to grow that fast? I mean, what's the 10-year growth in earnings per share?
11.8%.
Okay. So, if you're expecting a return of 10% or better, and people may not be, but if that's what you aim for in a stock, then you're expecting the stock to trade forever at 50 times earnings. So that's why it doesn't make sense to me. You can invest in something that has very high growth and you expect the multiple to come down over time, and that's fine because you're growing at 20% a year. You expect that to last for a while, so even though its multiple is going to contract to 20 times or something, you'll be okay. It doesn't make sense. And as we talked about, there's no long-lived retailers. So a retailer is not safer than other sorts of things. So it's a little odd from that perspective. Costco might be overcapitalized, might be able to have financial engineering. People might expect it to last a really long time. They might think all sorts of stuff, but it's one that's hard to believe that people would value that highly. It doesn't mean that it won't give you as good returns as lots of other stocks that aren't that great returns, but to be excited about it and to bid it up to that price is surprising. I just think it means that there's always people willing to buy Costco, as a stock, and so that's why it happens.
How do you think about companies that have basically no growth, but they're just cannibals, right? So maybe they have GDP type growth, but they take all of their cash flow and buy back their stock. How would you think about that? I mean, because the way people like to talk about growth is growth investors wouldn't be interested in a situation like that.
I don't usually like those kinds of companies because the problem is that human nature being what it is, they're not going to really do that. So as parts of other companies they do, at Berkshire they do. That's why Berkshire's successful with some no-growth companies. They're willing to have their premium volume drop as an insurer or something, but other insurers won't be willing to do that. And it's the same thing with other kinds of companies. If an entertainment company was facing a situation where their revenue is not going to go up, they're going to use it to buy other things that they think can grow revenue because no one's going to accept a situation where their company doesn't grow. Everyone tries to grow as fast as the economy or faster, No company's telling you that they want to grow slower than that usually. There's a few that do, and they pay out a bunch in dividends and stuff, but there's not a lot, so that's what they'll pursue. There's some evidence that companies that are quote-unquote growth companies have been able to grow earnings a bit faster than companies that aren't growth companies, but it's quite small. It's like a couple % a year on average, a basket of growth stocks versus a basket of value stocks. When you take the two baskets and then you watch what happens 10 years later. I did lots of things looking at like nets versus other things. You'd be surprised over a 10-year period, the growth in the earnings per share of the basket that's supposed to be deep value and the basket that is supposed to be a normal market are awfully similar over a long enough period. That people may be correct in projecting out the next couple years, but they have a harder time projecting it out longer.
How do you think about growth in the banking industry and at banks?
Well, growth is constrained by a variety of different metrics, right? So, but to a significant extent, it's self-imposed. So, what should limit banks' growth, like we talked about before, is return on equity, really. But it's not instantaneous because there's a balance sheet issue. So they can increase leverage. So we know the rate at which they could grow given some dividend payout or something with return on equity. So say return on equity, they had no dividend, they could grow at the rate of return on equity, right? That's easy to calculate. If they have a dividend, then it would be return on equity times 1 minus the dividend payout rate. And then they actually do grow faster or slower because they increase or decrease leverage over time, as you can see there. The banks we looked at that failed grew or came close to failing and all that. All of them basically grew at faster than the return on equity, and many of them also paid a dividend too. So they were growing at much faster than their sustainable growth rate. So they had to increase leverage over time or raise capital or increase their return on equity or decrease their dividend or some combination of all of those. I would say try to find banks that don't grow any faster than the return on equity. It would be better to have a higher return on equity and somewhat slower growth rate than the other way around. So like I think, what is it? SFBS. Do you know the ticker symbol for Service? SERVIS Bank. Service Bank Shares. Yeah, Service First Bank Shares. That's it. So here's an example of a high growth bank historically that also has high returns on equity through most of that period. Now, having said that, it's also at close to 100% loan to deposits for much of that time, right? Like a little bit lower than that sometimes, but for a commercial bank, it's very high. And it's kind of stretched to the extent that it's probably grown a lot at rates that are similar to its maximum sustainable growth rate. So if you really wanted a growth bank, you would want something like that has returns that are that high. And that's because it has a naturally high return on assets and everything, as opposed to a bank that has a lower return asset. You know, the one that's clear in the opposite way would have been First Republic, which was considered a fairly high growth bank, but it had a low return on assets. It was often 0.9 or something. So it never had higher return on assets than slow growing banks like Frost or something, but it always tried to grow faster, which is a bad sign.
How would you think about growth at a company like in the MAG7, right? The largest, biggest companies. Apple is at, looks like 25 times free cash flow, but there's other ones, like Meta, Google, let's see. Yeah, Netflix. How would you think about the growth in these sorts of companies? I mean, are these, positions, these stocks, is it just more so like, do you ever think about like, is it just liquidity? There's so much liquidity in the market and like with the Fed and QE and different sorts of things like that, even though they're not doing QE right now on paper anyways. I mean, how do you think about like growth at companies in MAG7?
Well, they're very big in terms of their market share. So, and they're in some of the biggest industries possible. So their total addressable market left is extremely small. Apple's a no growth stock at all. Like by most measures, it can't grow at all. It probably increases through service revenue growth and stuff that way. Amazon in the United States and stuff will lose market share over time. I mean, I was a huge Amazon customer since 20 years ago or something. And, well before COVID, my percentage spending on Amazon versus the rest of the internet peaked. And then it's been down since then. And that would be true for anyone who is an early adopter of Amazon stuff, just because everyone else, it's very easy to have websites and sell things online and stuff. And so it just drops over time. They can still keep increasing advertising and third-party stuff on their site, but over time, no one thinks they'll have a bigger percentage of e-commerce. Apple's completely saturated that way. Yeah, I mean, they're pretty saturated, most of them. I mean, they're all totally saturated, but NVIDIA and Tesla, the expectations are that they will grow their market size a lot. Netflix worldwide could grow their market size still, but they can't in the United States. Tesla and NVIDIA, I guess people would expect market share down, but market up faster than market share declines would be the expectation.
It looks like Netflix, they're basically back to their 2021 peak. We're not that far. $632 per share. Let's look at it on QuickFS. It's trading 50 times earnings, 40 times EV to free cash flow, $272 billion market cap. 10-year growth in revenue, the CAGR 22.7%, assets 24.6.
I mean, they really don't have free cash flow. I mean, it depends on how they define that, but those are contracts that they're bound to. So they're like if they were a publisher or something, this would be more obvious to people. But Netflix is spending more on content generally than it is actually generating in earnings. So it's continually increasing its balance sheet in terms of its commitments for future stuff. It's not unusual. Networks and stuff, they generate free cash flow, but they do sign deals to secure the Olympics and sporting events and stuff. Netflix has constantly been signing deals that expose it to more liabilities over time than it's bringing in cash, which is fine because then, it'll generate the cash later. And those people are safe. They're, senior to shareholders and stuff. So they're not worried. Look, the company's valued at $270 billion. They think they're good for their commitments, and their credit's been upgraded a bunch of times. But yeah, they're committing to more and more stuff all the time. So they actually pay more out the door than comes in.
So what are you talking about? People think about growth from a formula perspective. What do you mean by that? Is it they are trying to plug in like a 3 or 4 or 5% revenue growth? Yeah, let's talk about that.
This is the reason why it doesn't matter that much. Go to FICO, for instance, which we talked about, right? So try to figure out from 10 years ago what you think the stock would do. So you have revenue growth, which we've seen is that its revenue's doubled, right? Because over about 10 years, we've grown at 7% a year or something. However, that's a lot of price in there. They've changed some things in their mix, but that's a lot of price increase, not a lot of volume increase. So if you're measuring by saying what's the total addressable market and how much can they grow, you might have had a number very close to 0, but the revenue actually turned out to grow by 7. What did earnings per share grow by?
21%.
21%. And how much capital did they have to tie up to do that? Nothing. Because look, how much did assets grow?
3.1%.
Right. And it's not necessarily tangible assets. It's not necessarily equity, any of that. It really only matters if it's shareholders' equity that had to be retained. So if you look, they could buy back stock, which could drive the earnings per share growth. And what's with the share count, for instance? Let's look at that.
Yeah, it was 35 million in 2014, and we're at 25 million here today.
Another way to look at it is look at the balance sheet and look at what does it say equity was in 2013 or whatever.
2013 shareholders' equity was 531 million, and now we're at negative 688 million.
Okay, so you borrowed money and you bought back, right? So that's how you did it, which is it's not different from other things. Other companies I owned around the same time were like IMS Health, which did the same thing. The way it did it, though, is it was LBO'd. So it was close to no equity. It was buying back its own stock like FICO was, but it agreed to be LBO'd. And then they just took it to negative equity. I think Dun & Bradstreet probably had a similar experience because they were also taken private. So, it's a question of how much capital can you take out of the business and how much earnings can you grow. This is a company that on a number of scores done each year probably hasn't increased a lot over 10 years. And yet earnings per share has increased at 20% a year, while also not asking you for any more money, but in fact being able to, like we said, buy back stock and all that stuff. Now, they did increase their leverage, so they're more expensive than they appear to be. And we can see that on things like enterprise value to free cash flow. That's a very frighteningly high number. You're paying it a very high price. We can see similar things if you look at over-the-counter markets, which is very Fair Isaac-like. So what's revenue growth there?
Revenue growth, 10-year CAGR, 12%. Asset growth, 12%. Free cash flow, 15%. EPS, 17%.
And pays a dividend. Yeah. Not a huge dividend or anything, but it pays a dividend. And I think that's pretty close to Alphabet. My memory is that over-the-counter markets over the last 10 years in Alphabet was pretty similar until recently. So that gives you a good idea. Obviously, Google has grown much more as a business in terms of engagement of all sorts of things and stuff than over-the-counter markets ever did. But that doesn't necessarily mean that the earnings or anything grew faster. Like we said, what do we say free cash flow per share grew by? 14% or something here? And EPS, 15. What did it grow by?
17.
Okay, so 15, 17%, something in that area. Let's look at Alphabet.
Yeah, I mean, looks kind of similar. Revenue 19%, assets 14, free cash flow 19, EPS 20.
Yeah. And I think before COVID, you wouldn't even have it as good. And then you had a bump with COVID, which is in part revenue bump and expenses being cut too, because their revenue kind of went up at the same time that they thought they should cut expenses, as kind of happened with Meta. Whereas something like Meta was a very fast grower in terms of revenue and stuff because it was a younger company. But what matters is that EPS number and the multiple that you're getting. So, the growth things matter a lot when people believe that eventually they'll find a way to make it profitable. But once people lose faith in that, then that deteriorates a lot. And so as a stock, it doesn't work for you. And that's the problem that you have with, Tesla now, or it could be the problem that you had with Coinbase, right? If you actually look at the stock,
I think Tesla's having a tough year. Yeah.
Tesla's down a lot. Yeah. But that's a good example because we knew that Tesla would have a really bad year in terms of deliveries and all that. We talked about that at the end of last year, that everyone was overestimating the electric car market. But in this case, the stock did drop a lot, right? But other things, that doesn't necessarily predict that with MAG7 type stuff that the stock will actually drop just because it's going to have a bad year for its actual product. With a physical thing like Tesla, it's easier. We could see there's too many inventories of electric cars from all companies there. We could see there's too much capacity. People are preferring hybrids to electric cars. We went through all of that you could see. And so, but it's still a question of when that reality catches up to people in actually the stock. As you remember with Meta, right? I think it dropped the most in anticipation of a year in which it had a tiny decline in revenue and stuff. And then it came roaring back from that in a year where it had big improvements in earnings, basically, not because it had the best growth ever, but really because it had cut a lot of expenses and people were expecting the worst.
Yeah. I wonder how much stock they were able to buy back, because didn't they announce a massive stock buyback as well?
They may have bought some stock back. I don't know.
I always wonder that, when companies announce their buybacks, how, you have to announce it, and sometimes it moves based on that announcement. And then you're like, ugh, you wish the company could have just started buying it and say, hey, newsflash, we just bought back 50 million or 50 billion or whatever, a company like Meta, because it's you announce it and then the share price runs, and then Meta is having to sort of chase a little bit.
If they wanted to actually buy it back, they could. It's not a problem. You just give a high authorization before then. Berkshire Hathaway has a huge authorization. There's nothing that requires companies to do the authorizations the way that they do it. It's to get attention to the stock and then not actually carry out most of the authorized buyback amount. And not to tell you that they're burning off shares to give to people for a large part of the buyback, So people have to read the tea leaves of that. Yes, sometimes the stock surges on a buyback thing, but it's when it surprises people about the nature of it. When they have an unusual date to it, it's a very long authorization or it's a huge authorization versus what they've done, or they've never done an authorization before. Those are the kinds of things that move the stock. So how analysts do it, of course, and what Graham talked about years ago in security analysis stuff, not the book Security Analysis, but in the other things he wrote, articles and Intelligent Investor and stuff, is look, analysts can do it by saying things like price, volume, commodity type things. They do that. How much volume do we expect in the industry? What do we expect the price to be and all that? I don't know how useful that is, though. I mean, we can do that for what do we expect the growth for oil companies, right? But how far in advance can we do that? They give us information about how many barrels they have and where they're hedged at and everything. But it's not the most useful because it's giving you information about near-term growth stuff instead of longer term, which is what really matters. The simplest ones is ones that increase store count and increase, so we have an idea like restaurants and companies like that, or La Quinta when Lynch is talking about all that stuff. Those kinds of ones. He liked the ones that are very easy to predict that way. They're going to open things across the country and everything. The problems with these are that the growth may have very little to do with the stock. So in the example of Tesla and all that, you can look, their profitability has been all over the place. So growth is important. When a growth company fails to grow, it can be very important because it's an indicator of lack of demand, But when companies that are less growth oriented grow, it's not always as important because it's not necessarily as strong a profitability signal, right? In the case of Tesla, their profitability, like let's look at, and it's confused a lot by inflation, and they also have other segments, but inflation confuses it as the main thing because they hold the car for a long time. But if you look at, like, say, gross margin, okay, if you look at gross margin and profitability, for instance, then you're going to see something that's different than when we talk about insurance companies. What was most impressive about Tesla around the beginning of the pandemic is the improvement in profitability. If people think Tesla's going to go back to growing, but their profitability is going to be low, the stock will re-rate a lot. But if their growth is just weak for a little while their profitability is very strong, then you're not going to have the same issue. Here is a demand issue. It's not the inability to supply, it's that there isn't demand for it. So you're seeing prices come down in the industry at the same time that cars are piling up and everything. And sometimes in growth in industry is not related to that. Take semiconductor stuff. It's not demand related. They're supplying as much as they can. They can predict for you what their next quarter will be or something, because what there is just we can sell what we can make,
How do you think Buffett typically thinks about growth? So maybe he's doing the point-to-point
He doesn't buy
calculation,
high growth.
thinking in its head.
No, he never buys high growth.
So not in high growth, but like let's just say, slow, steady growth. I mean, Apple, for example, right? It's in no growth mode, but he has to be thinking about something. Growth.
The ones he
How
loves
is he
are
his return.
Geico, American Express. Those are the beautiful ones because they can grow at like about, if they used all their earnings to buy back stock and stuff, didn't pay any dividend, they might be able to grow at 10% a year in 1950 and 1960 and 1970 and 1980 and still be doing it 60, 70 years later. Those are the dream ones for him, are American Express, Geico. You can tell that those are the things that he's most excited about. You can also see where he broke down the table of See's Candy to break down growth and show you how the powerful thing about See's is that it didn't add tangible assets over time, but it did buy back. It did increase the number of stores a little bit, increase the pounds sold per store a little bit, and increase the price a lot. And so those three things together are very important. You can think about the quality of growth. Increasing price with nothing else is the highest improvement. Then you have increasing the your physical capacity, but having higher output per unit that you have there. So like MSC Industrial Direct is one of those where like it has excess space in a warehouse. Amazon has this with logistics stuff. And then you do more physical business with the same number of warehouses. That's better, not as good as price improvement, but it's better because you aren't building out more warehouses. Building out more warehouses is worse than that, right? And so it goes on. The best things are the things in which you're doing the least amount of physical stuff, increasing versus the increase in your profitability. The thing that Buffett does that's so different from everyone else is he's thinking about how much additional capital they have to put in everything versus the growth. Other people aren't thinking about that, and that's a really big factor. It's really great to not increase the amount of capital you have in the business, but to get any growth. And sometimes it's not that great to get growth without, like Amazon in the pandemic increased its capital a lot more than it increased its actual growth. So it became a less profitable business over time. Whereas, that's not the case for companies that are able to increase their revenue, but don't have to increase that. Like if you comped Amazon against FICO the last 5 years versus Amazon the last 5 years, the improvement in FICO is much bigger in terms of what it was able to accomplish without putting in more capital. Whereas Amazon put in a lot more capital. You can look at their balance sheet as a good example of what we just did, where we said FICO, the balance sheet shrunk over those years. Amazon, if we look, what was 2019? Let's take what was their balance sheet, total assets, and their equity.
Total assets were $225 billion. Equity was $62 billion. Now we're at or at least at the end of 2023, $527 billion and $201 billion. Equity.
Yeah. So they added what? They added 100. Did we say 140 million and 140 billion in equity?
Yeah.
Right. And then let's go to the income statement or the overview. to look at how much they grew. So let's say how much did they grow, gross profit or something like that from 2019 to today.
2019, we're at, I'll round up, 39 billion, and today we're at 94 billion.
Okay, so they increased gross profit by like 55 billion or something, while increasing equity by even more than that.
Yeah.
Right. Mm-hmm. So it took more than $1 of additional equity to grow gross profit by $1. That's can be okay in some businesses. It's not the end of the world. There are business, you never want it to be 0.5 to 1. Anything below that is really bad. But if you have huge scale, it could work. So it can happen. Their operating profit and stuff did go up over time because they have so much leverage. Yeah. Although, like we said, their equity per share is also at an all-time high.
Uh-huh.
Because they increased equity by so much. I mean, you would expect the market cap to have increased, what did we just say, by a huge amount. I mean, a very large amount between COVID and now. I mean, it has because the company's so big, right? What's the market cap of the company? Actually, it hasn't because it's just at the same place it was before. The stock is only at the same place. So it has
$2 trillion.
Okay. So like price to book and stuff isn't actually higher now than it was then because the stock was just as high back then. But it's higher than it was before COVID.
Mm-hmm.
So that's always a hard thing. So the long-term history of Amazon is very good, but when we get to the short-term history, it doesn't look good because it looks like the capital intensity is too high. But that can be unfair because we could be seeing a growth phase where Amazon has to invest a lot and they're going to get a lot of growth. Or we could see them investing a lot and they're not going to get a lot of growth, which would be bad. The one that didn't work out that way is Alibaba. They did like what we're seeing with Amazon, where they invested huge amounts of capital and got worse and worse margins over time. So although officially a growth business, the business got worse at like every year for the last long time. I mean, by most metrics of efficiency, they've been getting worse for 10 years.
Mm-hmm.
Even though they've been a growth stock for all those 10 years, or, that eventually their growth slowed down as they try to focus on profitability. But they were, if we just look at revenue, they are a pretty growthy company, right? What's their revenue growth?
Oh, yeah. 37%.
Now, in the last year or so, they're no longer a growth company, right? But most years they were a growth company.
Mm-hmm.
Right? Like how many years did they have below? Yeah.
I'll just read across for people listening from 2014 on. 53, 44, 27, 48, 73. And this is percentage revenue, year over year growth.
Yeah.
42, 29, 52, 22. And then last year was -6.
So you can compare that because if you look, like what does a quality investor look at? They look on return on invested capital. A growth investor looks at
profit, though. Gross profit's gone from 6.3 billion to 46 billion.
Mm-hmm. Yeah. But like we said, with the balance sheet and everything, you have to compare it to all of that. So for instance, if I look at return on invested capital, I look at operating margin, it's getting worse all the time. And what's interesting about that is just the way the math works. Generally, unless you have increased competition in your original business, which I believe they do have in this case, and that's why a lot of this is happening. But if you had a stable state in your existing business, that would mean that your incremental business has to be so bad for this to possibly happen. Now, I don't think that's possible. In this case, it has to be that their core original business must be getting much worse over time, much more competitive. And so that's the real reason why you see this. Sort of like we did a thing with Southwest Airlines and we looked that it once had an advantage over the industry. And then over time, it basically got to be looking like the other big airlines. The other airlines got better. Southwest didn't. They kind of, ended up in the same place. Here, this was once a better business than other retailers. Now it's exactly like them in terms of returns on capital and stuff. And as a result, it's the same in terms of multiples. It's valued like an old line retail thing. I don't think that Macy's or a Nordstrom or whatever would be valued any differently than like an Alibaba at this point. I don't think that Best Buy is valued lower than Alibaba. Maybe it is. I think it's come up in its multiple though over the last few years. So they could be pretty similar. Whereas 10 years ago, one had a really high multiple and one low. So, because you can see that with the graph. If you're looking on the video instead of listening to the podcast, you can see on return on invested capital something you don't like to see, which is the business is like been getting worse forever. It barely has ever any trends in a positive direction. And yet revenue growth is really high. So it still did have high EPS growth though, right?
Yeah. 21%. Yeah.
Yeah. How high was asset growth?
38%.
Yeah.
10-year CAGR.
Yeah. So
I mean, you're saying that they're basically not benefiting as much from their capital base.
I just say
It's
this.
drastically declined, which you could see in the return on invested capital.
It's hard to ever think of a business that's a good business that has 38% growth in assets over a 10-year period ever. A very high asset growth business is incredibly hard to sustain, and they're very rare. Even the fastest the MAG7 historically was probably Meta, and now we have Nvidia. We could look at those two because they're the fastest growing of giant companies, right? For 10 years.
Yeah,
I think so.
Asset growth in Meta 10-year CAGR 29%.
Yep, and a lot of those are not operating assets probably. But what was the EPS growth?
38%.
So a lot faster than the asset growth. And then with Nvidia,
25% asset growth, 52% EPS growth.
Yep. And that's because Nvidia's price. This is what I keep stressing. It's price, it's price, it's price. The asset growth of Nvidia actually is not as shocking. And so if you really think about that, you go, oh, what's a growth company? Well, apparently Nvidia, it's now it's huge as a market cap, but it's not that giant a company on the basis of assets and stuff. So Amazon has added way more assets than Nvidia has added, even though Nvidia is officially the growth stock. Asset growth is a lot lower at Nvidia. And like we saw with Meta, it's lower. I mean, you definitely want to have EPS growth higher than asset growth. In terms of being wary of a growth company, I would always be wary about the asset growth. And I would be wary about prices declining over time. There are companies that pulled it off, in their growth period and stuff. Intel and companies like that Dell did have declining prices at the same time that they had volume increasing by more than price. So their revenue was growing, just because they were in a business in which it dropped all the time. But those are the ones to avoid, is where asset growth is higher than EPS growth. But asset growth is like what the actual world sees in terms of their influence and everything. What you're seeing on all those trucks driving around with Amazon things and stuff, those vans and everything, and what you're seeing with the warehouses and the employment numbers and everything is the asset growth, but that's not what matters. What matters is the EPS growth, right? And as we saw, Meta did even better in terms of a growth stock where it matters in earnings, and yet it seems in the world that it grew less than Amazon.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If this is the first time you're joining us, be sure to check out all of our content that we push out into the investing universe. If you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.